every business you have ever walked into is running a machine you cannot see. The coffee shop on the corner, the airline, the company whose shares you own, same machine, every one of them, and it has been running for 500 years. In the next few minutes, you are going to watch one full turn of it on one small business, start to finish, and after that, a set of financial numbers is never going to look like noise to you again. First, the thing almost everyone gets wrong: accounting is not math. The hardest arithmetic in this entire course is addition and subtraction. I taught this for years, and the students who struggled were almost never the ones who were bad at numbers. They were the ones who had been told this was a math subject and never questioned it. Accounting is a language. It is how a business says what it owns, what it owes, and whether the year went well. And like any language, it has 3 jobs. Identify what happened, record it, communicate it to someone who has to make a decision. The whole language is built on one sentence. Assets equal liabilities plus owner's equity. What the business has on the left, who has a claim on it on the right. Meet Maplebean, a coffee shop that opens its doors with $12,000 of its owner's money. $12,000 of assets, nothing owed, $12,000 of owner's equity. The sentence is true. Now watch what the shop does to it. It buys an espresso machine for $5,000 cash. Assets do not move. $5,000 of cash simply became $5,000 of equipment. Still true. It buys supplies on account for $800. Assets up $800. Liabilities up $800. Still true. It serves coffee and earns $1,200. Assets up, equity up. Still true. That is the entire game. Thousands of transactions over a year, and not one of them is allowed to break that sentence. Doing that by hand, one transaction at a time, does not scale. So accountants run a cycle, the same steps every period in the same order. Analyze, journalize, post, trial balance, adjust, adjusted trial balance, statements, close, post-closing trial balance, 9 steps. And we are not going to name them and walk away. We are going to take all 9, one at a time, on this one coffee shop. And from here, on the bottom of every slide tells you exactly which step we are standing on. This map comes back in every chapter of this course. And if you stay with me to the end of it, you will be able to draw the whole thing from memory. Most people who start accounting never get that far. You can. Step 1. Analyze. On the 3rd of December, Maplebean serves coffee and takes $1,200 in cash. Before a single word is written anywhere, an accountant asks 3 questions, in this order. First, which accounts does this touch? Cash and service revenue. 2 of them, and there are always at least 2. Second, does each one go up or down? Cash goes up $1,200, revenue goes up $1,200. Third, and this is the one people skip. Which side is that? An asset going up is a debit. A revenue going up is a credit. Nothing gets written down until all 3 are answered. The students who got lost in Chapter 2 were almost always the ones who started writing at Question 2. Step 2. Journalize. Now it gets written. Once in the journal in a form that has not really changed in 500 years. The date first because the journal is kept in date order and nothing else. Then the debit, on top and hard left. Debits always lead. Then the credit, underneath and indented. And that indent is not decoration. It is how a reader sees which side a line is on without reading a word. And then one line of explanation, because 6 months from now, nobody remembers why. One event, written once, 2 sides. And the 1,200 on the left equals the 1,200 on the right. Step 3. Post. The journal is kept by date. The ledger is kept by account. Every account gets its own page, and posting is nothing more than copying each line of the entry onto the page it belongs to. The 1,200 debit walks over to the left side of the cash page. The 1,200 credit walks over to the right side of the service revenue page. The same figure, twice on opposite sides of 2 different accounts. That is all of Step 3. It is clerical, it is dull, and it is where a shocking number of exam marks quietly disappear. Step 4. The trial balance. Every account, every balance, on one page at one moment. Debits in the left column, credits in the right. And that is not a rule about what the 2 words mean. It is simply where each account normally sits. Assets and expenses on the left, liabilities, capital and revenue on the right. Here is Maple Bean after everything you have watched. $12,000 in from the owner, $5,000 out for the espresso machine, $800 of supplies on account, $1,200 of coffee sold. Cash, $8,200. Supplies, $800. Equipment, $5,000. Against accounts payable, owner's capital and service revenue, $14,000 and $14,000. It ties, and it ties because every single entry put the same figure on both sides. Stay on step 4 one more moment because there is a thing about it that will separate you from someone who has only skimmed this. Your trial balance balances. Does that mean the books are right? No. Miss a transaction completely and it still balances. Post to the wrong account and it still balances. Record the whole thing twice and it still balances. Balance is a check on your arithmetic. It was never a check on the truth. Step 5. Adjust. And here we jump forward because those 4 events were day 1 and a real year is thousands of them. Run that same loop for 12 months, then stop. The trial balance says supplies, $4,000. Somebody walks to the closet and counts what is actually on the shelf. $1,100. The difference was used 1 cup at a time and nobody wrote any of it down. A barista worked 3 days that have not been paid yet. Insurance was bought for a whole year and a month of it is already gone. Adjusting entries are the accountant catching everything that time did that no transaction ever recorded. Step 6. Do it again. Before the adjustments, that trial balance totaled $42,440 and it balanced perfectly. It was also wrong, which is the entire lesson of step 4. Then the adjustments land. Supplies drop from $4,000 to $1,100, and supplies expense appears at $2,900. One entry, both sides. And the page is proved a second time, $44,920. Every statement you are about to see is built off this page, never off the first one. Right statements built on the unadjusted page is the most expensive wrong answer I ever had to mark. Step 7. The statements. 4 statements, and every one of them measures something different and answers exactly one question. The first is the income statement, and it measures performance across a stretch of time. It has 2 ingredients, only 2. Revenues, what the business earned doing the thing it does, selling coffee, not borrowing money, and expenses, what it used up to earn that. Subtract, and you have net income. Maple Bean earned $22,650, used up $16,290, and made $6,360. And that is the only question this statement answers. Did we make money or did we lose it? The second is the statement of owner's equity, and it measures the owner's stake. How the claim of the person who owns this place changed over that same stretch. 3 ingredients, what their capital was at the start, the net income that just walked over from the income statement, and anything they took out for themselves. $12,000 at the start plus $6,360 earned, minus $1,000 drawn out, $17,360. Its question, is the owner better off than they were, and by exactly how much? Still step 7. The third is the balance sheet, and this one measures position, not performance, not a stretch of time. One single day. It lists everything the business owns, everything it owes, and what is left over for the owner, and it opens with that ending capital figure the last statement just handed it. Its question, what do we have, and who has a claim on it? Which is why the balance sheet is a photograph and the income statement is a film. One is true at an instant, the other covers a stretch. The fourth is the cash flow statement, and it measures cash, actual money in and out, which is not profit. That gap is the most expensive lesson in business, and plenty of people learn it the hard way. It sorts every dollar that moved into 3 buckets: operating, the day-to-day trading, investing, buying and selling long-term things like that espresso machine, and financing, money from owners and lenders. Its question, where did the cash come from and where did it go? It is the statement that explains how a business can be profitable on paper and still not make payroll on Friday. Step 8. Close. Then the year ends, and something strange happens. Revenues, expenses, and drawings all get emptied to 0, on purpose. They only ever measured one period, and leaving them running would quietly contaminate next year's profit with this year's, so they pour through an account called income summary, and what is left at the bottom, the profit, lands in owner's capital, which never resets. A basketball season ends. Someone resets the scoreboard to 0. Nobody takes the trophies away. Step 9. One last trial balance, taken after the closing. Assets are still there. Liabilities are still there. Owner's capital is still there and bigger than it was. Revenues, expenses, and drawings are gone, not deleted, emptied. 0. What is left ties one final time, 27,630. And this page is not a formality. It is next year's opening balances. That is the whole lap. 9 steps, and on January the 1st, the shop opens and step 1 starts over. And that is one full turn of the machine. Maple Bean opened with $12,000. It earned $22,650, spent $16,290. The owner took $1,000 out, and it closed the year with $17,360 of capital. Not one of those numbers was asserted. You just watched where every single one of them came from. So why bother learning it? Because these are the numbers underneath every decision anyone makes with money. Whether a business survives the quarter, whether a share price is expensive or cheap, whether the loan gets approved. People who cannot read this are guessing, and most of them do not know that they are guessing. Here is the road, and every stop on it is a piece of the lap you just watched. Chapter 1. The equation, assets, liabilities, and equity, and why every single transaction has to leave that sentence true. Chapter 2. Debits and credits and the whole recording process. Journal, then ledger, then trial balance, the engine that does the writing. Chapter 3. Adjusting entries. Everything time did to the business that no transaction ever recorded. Chapter 4. Closing in the classified balance sheet, where the temporary accounts go to 0 and the statements take their finished shape. Then the road keeps going past this lap. Merchandising, inventory costing, accounting systems, cash and internal control, and receivables. 9 chapters, every one of them free, with notes, exercises, and full mock exams. If you have made it this far in one sitting, you already have the thing most people never bring to this subject. You stayed with something that did not explain itself in the first 30 seconds. Screenshot this card, the whole subject, 1 page. The equation that never breaks, the cycle in order, and what each of the 4 statements measures. Then go and take the lap yourself, starting at Chapter 1. It is all free at appliedanalyst.com. I will see you in there.